Hi everyone, welcome to Cologne Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we'll summarize our top 3 takeaways from a recent interview between Guy Spier, a well-known value investor, and William Green, a business finance journalist and the author of the best-selling book Richer, Wiser, Happier. The current economic downturn and market crash is hitting investors hard. If you're having a tough time and struggling to figure out your next steps, this video will provide you some guidance. In this priceless interview, Guy Spier shares how to build enduring wealth by investing in extraordinary businesses that will survive and prosper over the long term. Before we start, if you're interested in this topic, please smash that like button so others can find this video as well. Let's continue. Now, before we get into the takeaways, for those who may not know, let's first share who Guy Spier is. He is a famed Zurich-based hedge fund manager who has beaten the S&P 500 by almost 250% points since launching Aquamarine Fund 25 years ago. He's also an author of the classic memoir, The Education of a Value Investor. With an MBA from Harvard Business School and a vast experience in the investment world, he is one of the sanest voices out there, especially at this time of recession and economic downturn. Takeaway 1. Invest in a way that's true to your own nature. Many a time, we get influenced by other people and get driven by emotions to invest even in assets that do not resonate well with us. It's not a surprise to find someone trying to copy the investment assets in a successful investor's portfolio. Here's the thing, even if your portfolio looks the same as that of Warren Buffett and you don't have the experience, patience, and the strategy Warren uses to win, you'll very likely lose money. According to Guy, you need to invest in a way that's true to your nature and your character. Guy shares that speculative trading is risky and is the reason why even some smart investors have many times lost heavily. According to him, outcomes from short-term investment can be unpredictable, but investing for the long term is very likely to succeed. He advises people to create a portfolio that is resilient and which can last generations. And to minimize risk in such a situation, Guy advises that you should split your bucket with a certain percentage into the most secure assets and another percentage into assets with the highest probability of high performance. Takeaway 2. Guard against biases and wishes. We've all been advised to be careful of scams when it comes to the world of investing. And sure enough, Guy agrees that there are a lot of people who only get into the investing business for the greed of your money. He has seen fund managers who get into the business, but due to a lack of track record, they try to use some dishonest schemes by pushing a deal that sounds attractive to prospective investors, even when they deeply understand that the deal is risky and it can't build a successful portfolio. Similarly, there is a group of well-meaning people who simply want to raise some money, but in the process, they get trapped in biases and eventually close shops as investors avoid them following massive losses. Therefore, to succeed in the game, Guy advises that you separate your wishes, learn to acknowledge and control your biases. Takeaway 3. Price really matters. Exercising caution when investing is very important. You need to do a thorough analysis to know why you're putting your money into a given asset. However much a company might look good with a solid balance sheet and with a good product, you need to ask yourself how much you're paying to own a piece of the company. And Guy agrees that price ultimately matters. According to him, it would be unwise to invest in a company when its stock price is at its peak because eventually you may end up realizing that you invested for nothing. In fact, when the downtrend picks up, your investment will eventually get wiped out. He gives an example of how people rushed to pay high for COVID growth stocks like Snowflake, Zoom and Roku among others without realizing that those companies were in fact at their peak. And sure enough, when countries started to ease COVID restrictions and the Fed stopped the quantitative easing, stocks of these companies plunged, leading to losses among those who bought at the peak. So the secret is to avoid getting influenced by market mood swings and focus on fundamentals. So there you have it guys, our top 3 takeaways from Guy Spier. be sure to smash the like button. It really helps others in finding this video, and subscribe to watch the part 2 of Guy Spier's interview with William Green for more insights. Thanks for watching, and we'll see you in the next video.